We need to get a photo of both of us up there for the intro. I think it would look a lot better.
We need to. I was just gonna introduce myself. I'm Tania Tatro, one half of the Tatro team, but we have both halves here today. I am with Rob Tatro, portfolio manager with the Tatro Wealth Advisory Group and Canaccord Genuity Wealth Management. I'm Tania Tatro, advisor with the Tatro Wealth Advisory Group, and I thought we would chat a little bit about all things market. We've had a little bit of a crazy couple of weeks as far as volatility is concerned. Lots of stuff in the news. And of course, we're getting some questions from viewers out there. And so today's a great opportunity for anyone who wants to participate in the discussion. And I think what we'll do, Rob, is keep this fairly casual, just kind of
yeah, we're here for clients' questions. We're here for if you're a prospective client out there and you want to ask us stuff. We also want to tell you what we think is happening, chat a bit about asset allocation, chat a bit about why we invest like we do for times like this, and basically fill you in on kind of what we see. One thing is clear, I think, Tania, you and I talk about this every day, is that this is, it's really, in our lives, it's really unprecedented. So a lot of the answers today might be, I don't know. It might be, it's too volatile, it's too short, it's too difficult to tell what will happen short term. But we're happy to be here, and we do want to make ourselves available to you guys.
Absolutely. So if you get the chance, make sure you subscribe to the channel, leave some comments. If you leave some comments, what we'll do is we'll try to answer those questions as soon as we can. So stick around and listen to the conversation. And well, should we start by maybe a little bit of a recap of kind of what we've been seeing this week?
Yeah, or we could even go 3 weeks. But yeah, so today, I mean, today the Dow fell a little bit of a rally though, and TSX was up. Yesterday, as we know, was a very, very positive day. But prior to that, we'd had a string of very, very negative days. I think the market is just so unstable right now. The craziest thing, so I was on BNN this week on Tuesday. I did a spot on BNN, and you and I have been doing global all week. We're on global news this morning. So we get kind of asked these questions every single day now. So the high for the the high for the Dow was right around 36.5 or almost 37,000. And today it's at 33. So we lost about not quite 4,000 points on the Dow. So 4,000 is just kind of over 10%. The S&P and the Nasdaq are a bit worse. Canada is,
and that's after a day yesterday that was pretty much best day in probably almost a year for single day gains for
2 years. I think it was the best since the bottom, since
that's
March
right.
20,
since July 2020, something like that.
There you go. Yeah. And that's when stuff was rallying like crazy. I mean, we gained 3% yesterday, and still we're still in bear country here with a 10% negative move. Canada's largely faring a lot better, and you and I both know why. It's the commodities, right? They're carrying Canada. We are a commodity-based country, so the oil stocks are a big part of the Canadian index. The commodity stocks, the mining stocks, the nickel and copper, and the wheat stocks, and those have all rallied a ton. So those stocks are doing well. So as a result, the Canadian index as a whole looks pretty good. But if you parcel out the different sectors, they're getting hammered pretty bad as well on the rest of the board.
That's right. Let's actually talk about commodities, because what's been interesting about the past few weeks is not only the volatility, but just how short term and how steep it is. Just even within a day or 2 days, we're seeing kind of all-time lows, all-time highs, or multi-year lows, multi-year highs within kind of the same week. And we saw that yesterday, and then again today. Basically huge gains and huge slides for oil and commodities all within 1 week, right?
March 8th, I will remember this day because there are maybe 5 days like this that I've had in my career where I vividly recall where I was. And the last one for me was the negative oil prices about almost 2 years ago, when oil went negative, meaning you had to pay someone to take a barrel of oil off your hands. This happened. I was here. I took a photo of it on my TV.
I was here. We talked about it actually in this office where we were. Yeah.
Like negative $30, I think it went. So they couldn't, it was a short squeeze, the opposite of a short squeeze, because people, there was no one willing to take those barrels, and they had to get rid of them. They had to fill those contracts. So they were paying people to take these barrels off of their hands. It's just an absurd situation. Well, on Tuesday, March 8th, I remember where I was when I was on BNN that morning, and we were talking about the nickel short squeeze, which the opposite was happening now. It was a true short squeeze. So a ton of nickel trades at $20,000. It went to 25 the prior day. Overnight, it went to 50. And in the morning, it went to 100,000 for a one ton of nickel. So it went up 5 times in like less than one trading day. And they just shut the exchange. The London Metal Exchange just shut it down. They said, we're not trading nickel anymore. It's out of control. So if you were a supplier and you needed to meet your demands, if you needed to be long nickel for whatever reason, you needed to buy some, you actually couldn't. If you need to unload nickel, you couldn't. You couldn't trade futures. You couldn't, which is like, think of all the firms out there that are just getting hammered by it. To me, that's a story I'll remember. And why? We know why, because the Russians control a ton of the nickel, and a lot of the nickel's made in Ukraine, and those countries are likely not producing a ton of nickel right now. So as a result, you see this monstrous short squeeze. I just saw the headline on BNN. The BNN TV is behind my camera here, so I kind of get to see the headlines as well. They're going to open up trading tomorrow for nickel. I'd be very curious how it trades tomorrow morning.
We'll see. And what about oil in all of this? Because a huge, ups and downs, even just between this week, right?
Yeah, I mean, if you've followed oil prices in your life or in your career, you're kind of used to seeing oil prices move a ton. But this has been wonky for sure. But I wouldn't say unexpected given what we've seen. I'm just pulling up the chart here for my own benefits. It closed today. WTI closed at 106 and Brent closed at just under 110. WCS was 95 or so last time I saw. So WCS is a Western Canadian Select. So that's our version of oil. WTI is West Texas Intermediate, and Brent crude is crude. Natural gas was actually up today. It's at 464. These are huge numbers, but remember that oil was it touched, I think, 125 or something like that. So we're down $20 from where we were briefly on today's what, Thursday?
On Tuesday
or Wednesday?
That's
yeah.
right.
Tuesday was a crazy day, right?
Yeah, Tuesday was a crazy day. And then yesterday was just crazy again. So we saw essentially a huge difference even within 2 trading days, records within those 2 trading days.
Yeah, like we were below $60 like a few months ago, but we were below $80 like at Christmas kind of thing. And like, or maybe I'm exaggerating, but it's really not that long ago that we were below $90 and then it just popped right up, right? So you're seeing it's the same thing, right? There are individuals and companies that are long. They need to meet their obligations. They can't meet the obligations. Supply goes down, demand goes up. You're seeing prices, at least they're stabilizing a little bit right now, but 106. If you have energy stocks in your portfolio, you are in a good spot right now. That's for sure.
So speaking of that, what do you think about investors who, they're watching the news right now and they're thinking to themselves, okay, well, maybe I need to do something. They get this impression that, there's some kind of urgency because of what they're seeing on the news. What do you think?
So if you're sitting at home and you're watching this, you have a few options. Okay. First off, if you're sitting on cash, now's a good time to be talking to your advisor about deploying some of that cash. Historically, when there are corrections, if you look a year out, 2 years out, you're typically always better off putting that money to work. Doesn't mean you put it to work today, but you make a plan to put that money to work. So if you got a $2 million portfolio and you're sitting on 200 grand of cash under your mattress in your checking account, call your advisor, make a plan to put that money to work. Maybe you put in 25,000 per week. You leg it in over 6 or 8 weeks or 12 weeks. Maybe you leg in if the market moves down. Maybe you pick some sectors. That's one. If you're fully invested, like most Canadians, in other words, your portfolio is fully invested, you're employed, but you're not able to just pull up 50 grand tomorrow or 100 grand tomorrow to put it in the market, then basically you have 2 choices. You could either do asset allocation, tactical asset allocation, which would mean selling some safe stuff in your portfolio and buying stocks, or you can just, unfortunately, wait for tactical opportunities. And for most Canadians, if you have the right asset allocation, if you've worked with a portfolio manager or an advisor and they've actually built your portfolio for a risk tolerance that matches what your needs are, you're likely doing very limited in terms of actual shifting of assets at this point. You could do some rebalancing, but we would not advocate for significant blasting of one piece of your portfolio and replacing it with another.
I'm happy you mentioned that, because I think that's really important to note that, a lot of the work when it comes to investing, it is essentially, figuring out the type of investor that you actually are from the get-go. And if you've done that, then, there's less to do when we see big changes in the markets like this, because essentially you would be already positioned where you would want to be, because the allocation is doing what it needs to do. It's doing its job, right?
Yeah, well, think of our 3 buckets, right? Think of the 3 buckets that we use for clients. Your equity, your fixed income, and your alts. Well, if you're with us and you're somewhat diversified and you're not like max aggressive, you've had a portion of your portfolio that's done really well through this. It's up, it's gained assets, it's gained. So that's what we preach, right?
Absolutely. Now, I saw a little bit of a question pop up earlier. It seems to have disappeared here, but maybe that now would also be a good time to talk about maybe some of the lingo and some definitions, because I know I get these kinds of questions all the time. So I saw a question pop up earlier about bear markets and how long they typically last. So I think we should start by kind of defining that, right? And then maybe we can answer the question after that. This is a Facebook question.
Yeah. So bear market is a 10% move. Let me just pull up. We have a neat chart here. Do we not have a neat chart here? I have it somewhere.
Because I think that the Nasdaq could have been defined as being in bear market territory over the last few weeks there, but with the little bit of rally that we had yesterday, it's kind of inching in and out of bear market territory.
Give me 1 sec, Tania. I want to pull that up.
Okay.
I have a neat chart for that. I should have had it ready. Yeah, so I have it somewhere. Whenever you're correcting 20%, right? Whenever you're correcting 20%, you're in a bear market. But let's find my chart right here.
Wait a second. You said 20%. I think you originally said 10%. 10% correction, 20% bear market, right?
Yeah, 10% is correction. I don't know what I said. Sorry. If I said 10% is a correction, 20% is bear.
Perfect.
And the reverse is also true. You're in a bull market when you're up 20. Okay, so I don't have that chart, Tania. I had it here, and I don't know what happened to it. Or give me a second. I can try to find it.
Okay. Well, while you're looking for that, we can chat a little bit about how long they last. And of course, that's going to be one of those questions that we don't know. And the answer is going to be, it depends. And that's exactly what everyone wants to find out right now, is how long is this going to last? And that's the one question that we can't answer because we don't have a crystal ball. But we can certainly kind of look back at some historical events and kind of see, what happened those times. But a lot of the time, there's nothing to say that, the events that are happening now are going to act in the same way as, a previous geopolitical event. So we can try to make some good decisions based on that, but it doesn't necessarily mean that past data will determine the future, right?
No, it doesn't. But I really like that chart. If I could find it, if someone could send it to me, Diggs, could you send me that chart? It's how long does it take to recover off a bottom? It's exactly the chart I was hoping to pull up. Stocks tend to do well after corrections. I have it right here, Tania. Okay.
Perfect.
So basically, if we look 1 year out after the lows of the last how many corrections here? Every correction since 1980. There's been about 25 of them. The average drop down has been about 18%, with the median being about 16. Okay, so you've had about one every year to year and a half. Okay, so every 12 to 18 months, you get one of these. If you look 1 year out after the lows, the average return is 25% and the median's 25. If you look 2 years out after the lows, you get 37% average with 45% median. 90% of the time you're higher. 90% of the time you're higher. There's been a few outliers where it's taken longer than a year or two to recover, but largely 90% of the time, on average, 25% return after 1 year and 45% after 2 years. So that's a significant move after a correction. And it's one of the things we have to remind our clients. Now, the tougher part of that point, Tania, is finding that bottom, right? Because it's easy to say if you just bought on the bottom, just like it's easy to say if you just sold on the day of the top. But a year out after corrections, it's a pretty nice number. Now, I don't have the chart in front of me, the length of time, but I believe it's something along the lines of, a 10% correction usually takes about 9 months on average to recover. And I believe a 20% correction usually takes around 15 months to recover. That's purely off memory. So if a viewer tells me I'm wrong, by all means, let me know, because I'm sometimes wrong.
I love that we have a question. Sometimes you're wrong. It happens. Me too. But so we have a question from a viewer here. The question is, what kind of review do we do to our portfolios when the markets fluctuate? And we kind of answered this a little bit already, but the second part of that question is, do you buy and sell, or do you just wait?
Well, do you want to handle it, Tanya, or do you want me to handle it? I can handle it.
Yeah, go ahead.
Sure. So basically what we've done historically with our clients, and anyone who's been with us, the last 10, 12 years or whatever, knows that if there are significant moves in the market, 25, 30% moves, we will do a tactical asset allocation shift. In that situation, we're actually selling your alternatives or your fixed income and shifting to equities. So that would be a tactical move, and we've done it. And you've heard me say it on BNN before. We did it in 2000. We did it right before COVID hit, and then we actually reversed that trade after COVID hit. And we actually did it back in, I think it was 2011 and 2018 as well. So those are tactical shifts. So that would be taking a large piece, because it's a monumental opportunity. When there's a monumental opportunity, there's a less of a likelihood that you're wrong. Right? If your market's already corrected 30%, the likelihood of it correcting another 30% is extremely slim, because those happened every 5 or 10 years, right? So if there's a phenomenal opportunity, we take advantage of it. But largely, tactically, on day-to-day trading, what we're looking for is opportunities that we might be moving names out that we don't like. We might be adding names in that we do like, but we're not going to be the portfolio managers that are going to say, let's blast all your fixed income and let's load up on stocks, or vice versa. Let's blast all your stocks and load up on fixed income. And why? Why do we do that? Why do we do that? Well, because here's the thing. We don't know what will happen short term. And when you try to do purely market timing on emotion in an emotional market, it doesn't work. Why? Because your opportunity cost of being wrong is too high. If you happen to blast all the stocks today and you go, you know what, I'm just going to wait in cash. I'm just going to wait in cash for 6-9 months. And I'm just going to, well, what happens tomorrow? The market's up 800 points. Okay, well, you know what? I'll wait still. It's going to come back down. Then you're up another 500, 200, 100. And next thing you know, like this happened in March 2020. Everyone who went cash, I know a lot of individuals who went to cash, they never got back in. They didn't get an opportunity. The market rally came back so quick that they never got an opportunity back in. And now you're sitting in cash. And now what do? The market's rallied 10, 15, 20%. Now what, right? And the same is true on the reverse, right? If you're buying, if you're loading up now and you get to see further dips, you don't have that ammo. And the reason you have asset allocation is to protect that capital, and it's to allow you to sleep at night. The reason that some of you are not 100% stocks is because there's a reason for your asset allocation. Likely that you either need tax efficient income, you want less volatility, maybe you have a purpose with a plan that you need to make 6 or 8% or 4%, whatever it may be. But there's a reason for your asset allocation, and shifting in times of euphoria, in my mind, is never a good idea. Yeah,
shifting in any extreme times tends to be a bad idea. But I think you touched on a good point there, which is that it's human nature to have loss aversion. And so this idea of kind of wanting to stay in cash, just, we'll just wait a little longer. We'll just wait a little longer. We'll just wait a little longer. It's human nature to have that loss aversion. And so that's why it's important to kind of remove that emotion and to actually, make the decisions based on logic, as opposed to, how our brains want to trick us. Right.
So yeah, I saw this graphic a while back. I sound like my dad now. I'm just making up stats as I go along. No, I'm kidding, Claude. I know you don't do that. But it was like, if you're missing the greatest week of the year in terms of returns, if you miss the greatest week of returns every single year, you actually have negative returns, right? Mm-hmm. So like the cost of being out for the most important week of the year is tremendous. And the likelihood of you getting a really good week when markets have corrected is a lot stronger than at other times during the year, right? Like the likelihood of a big bounce back is always when markets have corrected.
That's right. Well, we'd love to hear what our viewers actually think about this, because we'd like to hear kind of how you're feeling, whether you have any questions for us to answer, because we're here for that, guys. So please send them over in the comments section. I wanted to chat maybe a little bit about some other types of either strategies or hedges that people are asking about these days. So sometimes when we're seeing kind of the commodities move a lot in the situation, sometimes we'll get people asking, well, should I buy gold? Should I buy silver? Should I go to cash? What do you think about those types of strategies? I know what you're going to say, but I think we should address that, because it's a question we get sometimes.
So there's some portfolio theory that goes along the lines of owning 5 to 10% of your portfolio in commodities. And the reason that you would do that, and I'm talking about pure commodities, but the reason you would do that would to be, it's a hedge against inflation, and it's generally a hedge against situations like this, right? Because what happens in global geopolitical events is you get a shortage of commodities, and commodities go through the roof, stocks start going down. So that's the theory. The problem in real life is that commodities will go and have gone 10 years straight with negative returns, or 50 in a 15-year cycle, you might have 2 positive years. So that's really tough to look to your client and be like, I know we underperformed for 15 years straight, but trust me, there'll be a war soon and it's going to pay off. So what we do instead, we take a kind of a hybrid approach where we have commodities in the portfolio through stocks. So we focus on companies that deal with commodities. And, those of you that are clients, you've seen them in your portfolios. So that could be maybe oil stocks, or maybe, mining stocks, or anything that's commodity based. So we like to have a portion of the portfolio in that to kind of meet that hedge. So right now, the portfolios, the stocks generally are tanking. But like I said, the energy plays that we put in your portfolio are doing well.
Oh, great. We've got another one from Martin. Hi, Marty. Are real estate investments and alternatives a hedge against volatility? Absolutely.
You want to handle this one?
Yeah. So of course it'll depend on, the type of real estate investments that you have. There's certainly a difference in how public REITs and private REITs are traded. If you wanted to invest in real estate and you invested in, let's say, a public REIT, well, that's not going to do anything really. It's not going to do much to reduce your volatility, because it's still traded on an exchange on a day-to-day basis. It's still kind of subject to, some of the fear and the greed of any marketplace that you're going to have. So we tend to use alternative asset classes, and one of the ones that we like for many of our clients is private real estate. So a private REIT would absolutely be a great hedge against volatility, specifically, some of the companies that we've worked with, because since they're not traded on an exchange, you're not seeing the price move every single day. Now, it also can be a good hedge against a bunch of other things that are kind of could become a risk in a market like this. So not just
inflation.
Volatility. Exactly. That's exactly what I was going to say, because what's essentially happening is, if rates are going up, if things are getting more expensive, people may need to, rent an apartment instead of actually buying a house. And so if you're investing in multifamily housing, this could be a fantastic hedge against inflation.
The other big one too, the other reason it's a great hedge against inflation is, 40% of the CPI is housing costs. So if you own multifamily real estate and you're in an inflationary period, so more dollars chasing fewer goods, you get inflation. You get inflation on rent as well. And if you own the other side of that trade, you charge more for rent. Therefore, your net operating income goes up. Therefore, the value of your real estate goes up. So that is a very good thing if you own private real estate. And I'll tell you what, if you're our client, just take a look at the bottom of your portfolio, right? The last at the bottom, it says either alternatives or others. I forget exactly what it says, but you will see on there, Rise and some of the other holdings that we have in the portfolio. And they're all up. Whenever you bought them, they're all up quite a bit, and they've all kept their value right through this correction. So it reduces volatility, and the proof is in the pudding. We've now seen it. I don't know. We've had probably five or six corrections in our career, and every time those have held up well.
They have, and it makes for a more diversified portfolio, which overall is just a great way to reduce that risk. So we've got another one here from Celia. Thanks for the question, Celia. Should I sell some of my Canadian commodities to buy some US stocks?
So I think this question basically means, I'm reading into this, and you correct me if I'm wrong, Celia, like, are we at a top for commodities? I think is the question, right? Have we kind of topped for commodities? Was that the worst? Is the shortage of commodities at its worst? Are the prices at their highest, therefore selling at a top and buying US stocks, which would be, I'm thinking you're probably talking growth stocks that have corrected a ton. So you'd effectively be reversing that trade, right? You'd be saying, I'm getting out at a high on the commodities and I'm getting in at a low in the growth stocks. So okay, that was the question. Good. Thanks, Celia. So here's the thing. I don't know you, Celia, and I want to be careful to give advice here over social media. But depending on your asset allocation and depending on your goals, that could be a strategy that'd be good. So if you're now way overweight commodities because they've all doubled or whatever, and now you're underweight maybe US tech stocks or US growth stocks, you're heavily into Canadian stocks. Again, I got to be careful not to give you advice here. So the reason you were heavy in Canadian stocks is likely because you were, I don't know, anticipating or hoping for some sort of cycle like this. Now, commodity cycles, when they start, they don't necessarily often end in a month, right? Or 2 months or 3 months. So I don't think I'd exit the entire position, Celia, but it might be prudent to take a look at trimming, because here's the thing: in 5 years, is Google and Amazon, are they going to be lower than they are today? I can't make prognostications on stocks, but companies that are growing their shareholder return on equity every year by 20% and are trading at a 25 or 30 multiple, those are probably safe places to put your money as well. So I would talk to your portfolio manager and definitely take a look at your asset allocation, take a look at the risk. And like, this would be a reduction of risk for you, because commodity stocks have a higher beta than regular stocks. Have we explained beta? I forget.
No, we haven't. Beta? Yes, we should.
Okay. So beta is the relative movement of a stock relative to an index. So an index in this case would be this, let's call it the TSX. Your beta of your commodity stocks would be, for every percentage that the TSX moves, how much do these commodities move? These commodity stocks probably have like a 2 beta. So they probably move double. So that's pretty high. The other stocks that have a high beta are some of these micro cap, fintech, crypto, all of these kind of riskier growth plays. They have a higher beta as well. So you'd be reducing your portfolio. The lower your beta is, the lower your risk is in your portfolio. So Celia, that might be something to look at, but I'm not giving you advice, just to be clear.
That's an interesting comment. I think some people tend to be surprised at how volatile commodities actually are, because there's always this impression that that it's some kind of hedge or something like that, but it's actually the opposite. So they tend to move quite a bit just based on. Think of what kind of stock could actually move 500% in one day. Like you have to have a penny stock for that to happen, right? Like no Canadian bank, no retail, no travel stock, none of these could ever possibly move 500% in one day. And yet nickel, one of the most traded commodities on the planet, moved 500% in just over one trading day. And oil went from $30 to minus $30 in one day back in April 2020. So commodities are extremely volatile. Don't let anyone tell you any differently. Yeah. And susceptible to just general, political stuff and just world events in general. Much more
and
susceptible.
Short squeezes and all these things that don't traditionally happen to larger cap Canadian and US stocks.
That's right.
Except for GameStop, right?
Well, are we actually going to touch on those meme stocks today?
But Claude and I did 2 really good episodes on meme stocks when this started. If you haven't checked those out, go to our YouTube channel, check it out.
The episode,
and don't forget
on the short stories.
Yeah, it was so good.
So good.
don't forget to subscribe and like our channel.
And keep the questions coming. Whoever's got some questions coming.
I saw a headline today. I don't know if you saw this, Tania, the inflation. I think it was yesterday. The inflation numbers out of the US. I think it was 7.6% year over year for the month of February.
Wow.
So I had a question from someone to ask me to put on today. You know, what's going to happen to inflation?
Great question.
What do you think?
Well, I think a lot of that is, I mean, I think there's other factors to look at. We got to look at unemployment, all these other things, because I think to answer that question, we need to know whether this is really just like a short-term supply chain thing or whether there's other factors at play.
Well, this war is throwing a big wrench into that, right? Because, you know, the longer this continues, do not kid yourself, there will be inflation because, you know, Russia produces 5 million barrels of oil per day. Ukraine produces wheat like crazy and a whole bunch of other products. So, you know, I don't know exactly what's happening in Ukraine right now, but I don't think, you know, I saw a really neat note that went around, you know, they're the top producer of ammonia. They're the 4th largest natural gas line system. They have a 3rd largest iron exporter in the world and stuff like that. So that's like, those are costs to produce goods. So definitely if you get, Russia is, I think 12th on global GDP and Ukraine is 55th, if I'm not mistaken. So if you're taking, even if you're just taking Ukraine off the grid, I think it's about 0.5% maybe to 1% of the global GDP. So it's going to be a shortage of stuff regardless, if this continues.
Yeah.
And sorry, to push that thought out further, shortage of stuff means higher prices, right? It's just a straight supply demand thing that you probably took in some economics course in high school, or I don't know. Do they teach supply and demand in high school? I don't even know anymore.
I don't know. I don't remember.
But Claude always says more dollars chasing fewer goods, right? That's your inflation.
That's right. And sometimes it's short term, sometimes it's long term, but we've been kind of in a situation in the last kind of few decades where we, you know, hasn't really been this is the first time really in that this has become a big issue, right?
Yeah.
In a long time anyway. So let's see if we have any more questions. No more questions. We might have to come up with our own, it looks like.
Okay, we are so good at answering all the questions. I did have one from Randy today that he basically asked me, I'm going to paraphrase, but the question was basically, why didn't you sell, you know, at the top? Why didn't you sell all my winners kind of at the top? If you knew a freight train was coming, you knew this war was coming, you know, why didn't you sell? So thanks for the question, Randy. The answer to that, and I think you know what I'm going to say, but I'll say it anyways. I kind of answered it earlier. Humans generally have what would it be called, Tanya? Is it a recency bias, or is it, anyways, it's a bias that you think you think you always know what you would have done in that situation, right? Like I would have sold at the top. I would have bought at the bottom because, you know, I think it's a look back bias or whatever it may be. You're looking back and you're saying that was so easy to see because now you have the information, right? Here's the thing. When you're in, like, every single day, the market moves at real time, right? So that means the information that's available, the freight train, the bad news, the war, whatever is happening in the planet right now is being traded in the market on a second by second basis. That means unless you have legal inside information, and I don't know how you would have that in the situation of a global war, if your cousin worked for the Pentagon and knew that, no, because then it'd be illegal. But so you are the market, right? Unless you have a legal competitive advantage, you are the market, which means that all the information is already known and is already being traded on. So if you're making a sale, you're basically saying that I know more than the market. If you're making a buy, you're also saying that. So the reason we don't go all cash or all fully invested is what I said earlier. It's asset allocation. It's protecting capital. It's long-term growth. It's historical movements of markets in market corrections. When markets crash, it's not pleasant for a while, but do we get out? No, because if we miss that rally on the way back, we've now lost 5 years of returns for you, right? So the opportunity cost of screwing that up is so much greater than the potential benefit of the market falling another 10% and then you buy it. But the next question would be, okay, so let's say you were to go all cash. Okay, you're going all cash. You thought this freight train was coming. So this freight train, I'm going to dodge this freight train. This freight train's coming, which is a war. I'm going to dodge it. And then the market tanks. And then I'm like, how are you going to then decide to buy back in? Are you going to have a legging in strategy? Are you going to just go all in? And when are you going to decide to go all in? So we believe in tactical shifts. We believe in moving small pieces of money to sectors that are undervalued. We believe in doing that on a regular basis. And we believe in taking advantage of these situations. And we also believe in telling our clients if they have cash at home, now's a great time to be adding to their portfolio. That's what we believe in. And I'm never going to attempt to dodge a freight train because I don't really know if that freight train's going to hit. I don't know more than the market.
Yeah, and I don't know if the freight train is necessarily the best metaphor here, because the reality oftentimes is also that, the time horizon is long enough, and most of the time, the portfolio contains companies that we know that regardless of what happens in the market this year and next year, we're still going to want to have that company in our portfolio 5 years from now and 10 years from now. And so every time we, if we were to capitulate, we're essentially kind of having to rewind and almost start all over again, like you say, and then we have to try to figure out when to re-enter the market. So it tends to not be a very efficient way to do things, even if you could actually predict the bottom or the top, right?
Yeah, I mean, if I knew for a fact that, by the way, today's March 10th. So March 9th was the bottom in 2009. This was March 9th was the bottom in 2009.
That's right.
The day's just in my head.
I was just starting to quote about that yesterday, actually. That was the bottom. That's right.
Guaranteed he remembers and circles that day on his calendar. I remember we were driving up. We were on a road trip somewhere.
In Mexico.
And I just remember that Claude was like, yeah, this is bad. This is bad. Like that was like a 50% correction. And I remember my dad's like, I'm debating. I've never ever in my life debated, going to cash a little bit. And then my mom said, you know what, call the office and let's put some trades in. Let's put some buys in, because that means we are really close to the bottom. If you're almost capitulating, Claude, we must be really close to the bottom. I don't think he would have capitulated, but he was like thinking about, oh my God, this is really bad. So they ended up buying a ton right at the bottom, and Claude and Annette, my mom, ended up making a great trade on that. But anyways, that was 13 years ago. Sorry, I went on a tangent there.
That's okay. It's a good tangent. I like it.
It's tangents. It's what we do.
Yeah.
And the other thing is, if you attempted to dodge every freight train, you know how many things in the markets are never freight trains that the media
it's
makes
like
out to be a freight train?
It's like a detour, maybe not a straight.
Like there's been, like, I remember when like Ebola came, like we had a branch meeting and everyone's like, okay, it's time to, shore up the portfolios and go to cash. This thing is going to be really bad. And it was like one day down 500 points and a blip, right? I think of like all these geopolitical attacks that have happened in the last, in my career, that are like, okay, this is going to be bad. And they're not freight trains. So if you sell there, you're selling for no reason, right? Yes, had I known that it would be this bad, obviously it would have been nice to go cash for a portion of the portfolio. But even then we wouldn't do it, because it's not what we believe in, because the opportunity cost, right?
That's right. Yeah. And there is no way to know. There never is. So
the best you can do is asset allocate, make sure you have a great strategy to reallocate, and be ready if ever there's really bad moves to move money.
And I'd like to add a comment on that, because I sometimes find that people are too hard on themselves with that exact bias, that recency bias or whatever it's called.
Oh my God.
I should have done this, or I should have done this. Oh, I should have bought this, or I should have sold that.
We are terrible as humans for that.
Yeah. And you just can't beat yourself up about that, because there is no way to know, right? Yeah.
Yeah. Unless you're Marty McFly and you happen to have jumped in a DeLorean and gotten Biff's almanac from the back seat in Back to the Future, you don't know what's happening in the future. That's one of my favorite movies. So I thought I'd give you a Back to the Future reference. Great Scott, Marty.
Speaking of Marty, we've got another question.
Marty.
Thanks, Martin. So, this is interesting. If hindsight is 20/20 and the future is uncertain, what should you invest in today, seeing as the future is uncertain?
Do you want me to answer this?
Yeah, go for it.
Okay. So One thing we don't know is what's going to happen in the short term in the future. Okay. We know for a fact that we don't know what's happening in the short term. One thing we do know, if you use historical averages for stock market indices return, either Canada or US or global for the last 50 years, 100 years, 150 years, assuming that data will replicate itself. And I'm not guaranteeing anything, but based on that assumption, we know that the market's going to be up in the future at some point. Every single time in the last 150 years, when the stock market has corrected 10, 15, 20%, every single time, the stock market has made new highs, 100% of the time. So here's what I would do. I would make a plan for how much capital you have, and we would build a plan to invest that capital. So again, I've said this earlier, but if it's 100 grand, well, then we would strip out different sectors that we want to invest in. We touch up some positions. We probably look at some underpriced US tech positions, some Canadian, but largely we'd be buying across time and across different sectors so that we're properly protecting the capital, reducing the market timing risk, and making sure that you're participating as much as possible in that upswing.
I like how you put that. And I think that actually brings me to another point / question, which is oftentimes there's a lot of emphasis on, hey, what should you invest in today? So there's emphasis on, a specific company or a specific stock or, a specific position. And I like that you mentioned that cross section and that variety, because I think when you're asking a question like that, what should you invest in, considering that the future is uncertain? I think that it's really important to look at the big picture and to look at the entire portfolio as a whole, rather than kind of, try to think about, this one pick or that one pick, right? That's something.
The one pick game is not it's a game that's fun to play if you're, gambling with a buddy to pay the lunch or whatever.
But it's a game. It's not.
It's truly a game.
It's
and
gambling.
In fact, today, I asked 4 people that I trust and respect a ton, 4 smart portfolio managers and analysts, if they had to pick one stock that in 1 year is going to be up from today, as long as it's up from today and they don't take your firstborn, what stock would you pick? I asked 4 incredibly intelligent individuals that I trust, and I got 4 totally different answers from 4 totally different sectors. One of them was saying a financial, one of them saying a US tech, one of them said a commodity, one of them said, so in other words, my point is that why not just buy, if you're going to be buying today, let's take a look at some of the sectors that are underpriced and let's buy, across different sectors.
Yeah. I like that strategy. And
by the way, you shouldn't be gambling for lunch money on one stock, but I'm not endorsing gambling in any way.
Well, the interesting point of that too, though, is you got 4 different answers, and there's a good chance, they might be right? All of them.
I should mark it in my diary and follow it up in a year and see.
Yes, absolutely. Put it in your calendar. Give yourself a reminder a year from now to call them. But that also brings another point, which is that if you start playing the individual pick game, there's just so many out there. There is no way that, that any one individual could be the one who would pick, the best out of everything, but because there's so many that could be right? So your little experiment kind of showed that today.
Mm-hmm. Yeah, it was a fun one though.
All right. Do we have any more comments or questions, guys? We've been at it for about 45 minutes, and we would love to hear what you have to say. And if you want, you can even, you don't have to use your real name. If you want to ask a question, anything, ask us. We'd be happy to answer.
If not, we're happy to shut her down too, and we could do this again some other time. Maybe just a last comment I'll make, just about kind of the forecast for the rest of the year, a question that comes up a lot. So, Rob, what's going to happen? What's going to happen the rest of the year? So again, we don't know what'll happen, but one thing we know for sure is that expect volatility. And these are the tough times. The reason you own equities is they have the highest expected rate of return in your entire portfolio. So if you're one of our clients, you have 3 buckets. You have stocks, you have fixed income, and you have alts. All right. The stocks, if it's the smallest or the largest part of your portfolio. It's what is driving the alpha, the returns in your portfolio. So if you own that, the reason we have that piece in there is because it's going to generate the most returns. Now, it also comes with the highest volatility. So these other two buckets are doing their job, the fixed income and the alts, and they're stabilizing your portfolio. They're generating monthly income or quarterly income, and they're not at risk right now, or we're not expecting at any time in the future to be at risk with everything that's going on. So when you own this first bucket, you take the good, you take the bad, you take them both, and there you have the facts of life. That's a show that I used to watch. But remember that there's no free lunch, right? So if you're getting that 10, 12, 14% return in your equities, this is why this is the price to pay for that. And I know it sucks, but I'm just reminding you why you own it. You own it because over the past while, and 50 years, 100 years, whatever you want to use, they've generated the best returns out of all three of those buckets. So there's a reason they're in there. They will come back, and just like I promise you, we will take advantage if we have the opportunity to do so. The good news is, if you're our client, is that we basically have half the stock exposure that most of our competitors do for a whole bunch of different reasons, but you're dramatically outperforming right now. I mean, I know that sucks relative to the index. You're dramatically outperforming right now. I mean, that's always, hey, you're down less than your friends are is not great news, but it's news anyways.
Yeah. Well, let me ask you this. Do you think that, should we be watching, how much of this do you think is coming from, pandemic, supply chain? How much of it is Ukraine, Russia? How much of it is just kind of, some bubbly, frothy tech markets? Or do we not want to go that far into those details?
No, we can definitely. I think it's a piece of everything. I do think the pandemic concern for the market, I think it's waned dramatically. I think it's largely gone or almost gone. I don't know how your lives are in your different cities, but Winnipeg, I think it's next week. There's no masks and there's no vaccine mandates, and things are moving rather quickly. Supply chain is definitely an issue, but I mean, even that was getting taken care of. To me, this market is being driven by three things. It's inflation fear, it's interest rate fears, and it's global macro, probably 70% of it in my mind, what's happening in Russia. Now, the interest rate risk, that kind of went away, right? We were talking about 5 or 6 rate hikes this year. Well, it's March 10th. Are we going to get 5 or 6 rate hikes? Again, if I had to gamble on that, which I won't, I'd say absolutely not. They were talking about 2 rate hikes next week. Well, we're not going to get 2 rate hikes next week. That's not happening. No. So expect to see less of that. And why? It's because you can't raise interest rates in kind of uncertain times or unhealthy economy. So they're not going to be raising interest rates. Inflation and the global macro problems, and they're kind of tied to each other, right? Now that supply chain looks to have been taken care of. So the inflation risk was supply chain driven, right? Before it was pandemic and supply chain driven. Before Russia attacked Ukraine, inflation was purely caused by supply chain and COVID problems. And it was, it's starting to look like it was taken care of. They were forecasting 2.5%, 3% for the next 12, 24 months. Now, though, the longer this geopolitical event goes, the higher the likelihood of prolonged higher interest rates are. So that's the two things that are worrying the market right now. But obviously, if there's a ceasefire tomorrow, or I don't know, Putin somehow gets removed or something happens to him or something, you're going to get a significant bump in the market. Like, that's happening for sure. So all I have to say is you want to be invested whenever that happens, because by the time it happens, it's too late. You've missed it, right? You've missed the 2,000 point swing or the 3,000 point swing.
Yeah, and these kinds of things could just happen day to day. It's there's no way to know. What do you think is the kind of the other side of that, like worst case scenario? Could we see more sanctions to other countries, or could that possibly kind of turn into I'm being devil's advocate here?
Yeah. So I think the worst case, I think, is that somehow this like, I don't know how it will prolong forever, because there's food in the grocery stores, and Ukraine had some resources, but like, these people are now dying. They're going to start starving. Like, this is going to be an unmitigated disaster in Ukraine. So I believe the countries, they're going to put their foot on the pedal with respect to Russia. They're not going to let I believe that the the developed nations are not going to let they're not going to let Ukrainians die en masse. That's my view. So that means something against Russia. China, I think, is the wild card here. I think if China decides, so I saw a headline today on CNBC that there was one analyst who said, China looking to impose sanctions on Russia. I think that would be the end of Russia, because right now it's kind of the only place they could sell their oil and sell their products and is China, right? So China's buying their stuff, and then China maybe will choose to not buy our stuff or the US's stuff or Paris's stuff or Germany's stuff. So that's a concern. I think the supply chain there, like we're going from we're going from fully globalization for every year that I've been alive. We've had more and more globalization, something like that. That was a lag. That wasn't me mispronouncing my words. And now, more free trade agreements, year in, year out, every year of my life. And now we're like going backwards, right? So that's not good for global GDP. So the worst case scenario would be, I think, a prolonged block of something like Russia, maybe some African countries, China, and maybe some Mideastern countries, and I don't know, some South American countries that are kind of trading between themselves, and the rest of the countries have sanctions, and you kind of get this split world, and there's way less trading, and that would not be good. I think if Russia overtakes Ukraine in some sort of way, and again, I'm not making any comments on what I think is a good thing or a bad thing. I'm clearly anti-war, and my wife is signing up to kind of host a family from Ukraine kind of thing. So I'm making comments here on what might happen to the market. So I think if Russia were to invade Ukraine and somehow, instill a government and kind of win that war, I think the market would see that short term as good news and would kind of just be like, okay, this is not that bad. Okay, I know it's not great, but the stock market largely looks past these geopolitical events. Short term. I think long term it'd be bad for the market, because then what's coming next? Hungary and Poland and whatever. And every time you'd have an attack, you'd have. And I think your best case, would be, global sanctions, which is choking off Russia. Their people start starving. Their people start, because they can't get their food, they can't get their supplies. If everyone stops trading with them, eventually they're going to run out of stuff. 1960 Berlin, kind of same situation. And then you just have either a coup or an assassination or something, and you have a revolt and you go back to how life was before. And then I think you'd get an influx of capital to rebuild Ukraine, and then you'd slowly get back to life.
And then that would be like a post-war boom.
Yeah. And I don't want to, I don't want anyone to email me about my opinions on this. I don't have opinions on this. I'm not trying to rant on anything here. I'm just what might happen to the market.
Yeah. And that's just what we're talking about today's effects on the market, and, what could be the possible factors that are into play here, because we are seeing, that's the thing with the markets, is that it's all about the investors and their feelings about what's going on. So this morning actually reported on how Starbucks had quite a little bit of a little rally there. I think they were up 4%, I think, yesterday, and that's after they had announced that they were going to cease business there. So that's short term. That's kind of what we see that the markets just kind of react in the short term initially. And then we just have to kind of wait and see what happens.
Yeah, Burger King announced today that they're shutting down all operations in Russia. So, I mean, the guy in Moscow who's not getting his Whopper is not going to be happy, right? So, yeah, at some point. All right, I think that was a good session. Thank you for your time, everyone. Sorry, I'm not the host.
That's okay. No, thanks for everyone who sent in the questions and for everyone who commented. If you like our content, make sure that you subscribe to the channel and join us next time we do another Q&A. If you have any specific topics you'd like us to do a show on, please leave it in the comments. Let us know, and we'll be happy to try to pick up some of the topics that you'd like us to talk about next time.
Don't forget to like and subscribe.